to Staffworks Explained. Is it your first time here? Please consider subscribing to this channel. Watch different videos that you have done on various topics. Leave your comment, like, and share. For repeat viewers, we thank you for your support. Today, we'll be talking about Uganda Oil Refinery. Is the search for the refinery investor going to be yield fruits this time? Ever since Uganda discovered commercially viable hydrocarbon deposit in 2006 in the Albertine region, where the current reserves of crude oil are estimated to be about 6.5 billion barrels, there has been a beehive of activities, and this is towards realization of the first oil. One of the key projects is building of a refinery that will process 60,000 barrels per day for local consumption as well as selling to the neighboring countries. The date for first oil in Uganda is set to be 2025, but challenges continue, with the latest being the failure of the Albertine Graben Energy Consortium (AGEC) to secure funds for the project. Albertine Graben Energy Consortium is a group of 4 international companies that were previously slated to develop and operate the Uganda Oil Refinery. These companies are: we have General Electric of United States, which is responsible for engineering, procurement, and construction of the refinery. Then we have Yaatra Ventures LLC from United States, which was supposed to provide equity financing and development expertise. We have Intracontinent Asset Holdings of Mauritius, which was to focus on managing project risk and securing financing. And then the fourth company is an Italian company, Saipem SPA, which was to handle pipeline construction and also transportation of crude oil to the refinery. In 2018, this consortium signed a project framework agreement with the Ugandan government for the development of this refinery, which was supposed to have a capacity of 60,000 barrels per day being processed. They conducted the front-end engineering design (FED) and completed it in 2021, and they received approval from the Petroleum Authority of Uganda in 2022. However, they have failed to secure the necessary financing for the project within the allowed timeframe. On June 30th, 2023, the project framework agreement with this consortium expired, and the Ugandan government decided not to renew it. They are now seeking new investors and partners to take over the development of the refinery project. The government is seeking new investors for this 4.5 billion refinery after the PFA with the consortium, which is led by America and the Italian firms, expired in June 30th. The Ministry of Energy said that while the Albertine Graben Energy Consortium had made significant development, it failed to mobilize critical financing, for which the government was seeking new capital. The ministry said in a statement that the number of outstanding aspects, including mobilization of financing for the project, and the government of Uganda is now open to receiving offers from public sector capital providers to participate in this nationally and regionally strategic project. Although the government did not extend the PFA or sign an implementation agreement with the consortium after its tenure expired without making a final investment decision on which it had been promised when it signed the PFA in 2018, they still appreciate that this company had done something, and the window was still open if this consortium wanted to continue. The refinery was to be financed, or is to be financed, through a debt equity ratio of 70:30, with the task of raising much of the capital falling on the private developer, and this is what the consortium failed to do, and leading to government not renewing the PFA. In March 2023, the Ugandan signed a wide-ranging memorandum of understanding with the Algeria government-owned energy firm Sonatrach Petroleum Corporation on the midstream and downstream development of Uganda oil sector, which includes the refinery. Sources indicate that the Ugandan government was growing jittery at the time over the lack of progress with the AGEC consortium, since they had failed to move forward and make an FDI and develop the refinery. The Ministry of Energy said that the MOU with the Algerian company Sonatrach was because they have to look at their own interest. It was a few weeks to the end of June from which the contract or the PFA with the consortium was expiring. The other option was to mobilize East African community partners, states of Kenya, Kenya, Tanzania, Rwanda, Burundi, South Sudan, and DR Congo to commit to taking up equity, while capital investment from public-owned agencies has also been mooted. In 2014, Uganda offered 40% of the refinery shares to the East African community partners, that is Kenya, Tanzania, Rwanda, Burundi, South Sudan, and DR Congo. DRC was not in the mix then because they joined EAC in 2022. Each of these countries was supposed to be allocated an 8% stake. Only Tanzania accepted the full 8% offer. Kenya took up a significant smaller stake of 2.5%. Rwanda and Burundi did not express any interest. South Sudan and DRC Congo were not actively pursued due to internal political and economic stability, and also DRC had not joined the EAC then. In 2023, the President Museveni revised the offer, increasing the potential individual stake for interested EAC partners to 8%. This was done in hopes of attracting more investment. Based on the current situation, the possibility of EAC states collectively honoring the 8% stake offer appears moderate. While the revised offer and potential benefits are attractive, significant challenges remain. There are potential scenarios that can happen as far as this stake is concerned. The highest possibility, which is 30 to 40%, few of the states can take over the offer. For example, Tanzania has already committed 8%, and Kenya has committed 2.5%. If Kenya can increase its stake, probably some of these issues that the project is facing can be at least mitigated. Then we have moderate possibility, which is 40 to 50%, where some stakes or some states take up partial stake, but full collective participation remains elusive, and this due to individual financial constraints or competing priorities. Then we have low possibility, which is 20 to 30%, where East African states ultimately decline the offer which has been offered, and this is will see Uganda pursuing alternative funding options with the private sector like Alpha MBM, and this is what the government of Uganda has done. It seems that other East African countries are not interested in taking up full stake. It still remains that Tanzania took 8%. Kenya still maintains its 2.5%. Other countries have not expressed any interest, and this probably is what, with failure of Albertine Graben Consortium taking up or making financial investment decision, then Uganda has no choice but to look for other investors. So according to the Minister of Energy, Uganda is now seeking with an investment company led by member of Dubai royal family to develop a planned 4.5 billion refinery. Negotiations on the key commercial details between the government and their UAE-based Alpha MBM investment are said to have started in January 16, 2024, and are expected to be completed within a period of 3 months. Alpha MBM Investment LLC is a Dubai-based investment firm which is headquartered in Dubai International Financial Center. It was founded in 2012 by Sheikh Mohammed bin Maktoum bin Juma Al Maktoum, who is a member of Dubai royal family. The company operates across diverse sectors, including agriculture, infrastructure, energy, and also real estate. It has stated in its website that its mission is to partner with the best in class companies for purpose of driving impactful project. The company focuses on emerging markets, particularly Africa and Middle East. It invests in companies with strong potential for growth and sustainable impact, and also it focuses on value innovation, collaboration, and also social responsibility. Some of its recent activities is what we have mentioned here. It's negotiating with the government of Uganda for potential investment in this refinery project. It also launched a $1 billion agricultural investment fund targeting projects across Africa. It has also invested in several renewable energy projects in the Middle East and also in Northern Africa. There are some controversies where there has been some concerns expressed about this company and its ties with the Dubai royal family and the potential for lack of transparency in their operation. However, the company has stated in its website that they are committed to ethical business practices and corporate governance standards. So Uganda expects to start pumping the commercially oil in 2025 from the fields of Albertine Rift Basin in the country's west, which is near the border with DRC. The fields are jointly operated by the government of Uganda through the state-owned Uganda National Oil Company. We have the China's SNOC and also Total Energy. Kingfisher is one of the two commercial oil development fields. Then we have Tilenga, which is operated by Total Energy. The refinery is planned to be 60,000 barrels per day refinery in terms of capacity, and it will be found in Kabale, which is in western Uganda. This would be a significant development for the country, which aims to boost its regional fuel security, drive economic growth, and also promote value addition. However, there are challenges such as financing, where finding investors and securing funding remains a problem. There are also environmental concerns, where potential environmental impacts of the refinery and pipelines need to be carefully considered and mitigated. There are also concerns with land acquisition and potential displacement of local communities, which require sensitive handling and social investment. With the previous consortium out of picture, the Uganda government is now seeking partners to invest and build the refinery. Alpha MBM Investments from Dubai is reportedly in talks with the government, but a final agreement has not yet been reached, and it is expected that this agreement can be reached within a period of 3 months. So in terms, how will this turn out? Will the talks between Uganda and Alpha MBM yield fruits? And even if they yield fruits, will the company, or will this company from Dubai go ahead and make the final investment decision? Predicting the outcome of the talks between Uganda and Alpha MBM Investment for the Uganda oil refinery is difficult. The outcome of the talks depends on various factors and potential scenarios. On positive factors, we have increased financial potential, where Alpha MBM has a significant financial resource and could provide the necessary capital for the project, overcoming these challenges that are faced by this country. Then there is faster progress, where private investors, such as this company, are often more agile and decisive than the government partnerships. Potentially, this will accelerate the project timeline. Then there is the aspect of technical expertise, where these Alpha MBM might bring valuable technical expertise and experience in managing this project. From a negative point of view, we say that there are transparency concerns with this company, where some might raise concerns about the transparency of the deals with the private sector, particularly those with links with the powerful individuals or families, like is the case with Alpha MBM. This also applies to reputational risks. Any controversy which is surrounding Alpha MBM could reflect poorly on the Ugandan government and the project. Uganda seeks to ensure it negotiates a fair and equitable deal that protects its long-term interests in the refinery. In terms of scenarios that may come out of these talks, we may have a successful agreement where Alpha MBM invests in the refinery, bringing the necessary funding and expertise to move the project forward. This could be beneficial for Uganda and also the whole region, and this will bring faster progress in project and also economic gains. There could be partial agreement where Alpha MBM invests but alongside other partners including EEC states or other private sector. This could mitigate some risks and also ensure broad ownership and control. Then we could have a scenario where there is a negotiation breakdown, that as it happened in previous three attempts. Talks could fall through if either party finds the terms acceptable or encounters unforeseen challenges. Uganda would then need to explore other alternatives to fund this project. It is important to take in consideration that we have issues of global oil market conditions where prices have been fluctuating, and this could impact the feasibility and investor confidence. Then we have the Uganda political and economic stability, where a stable and predictable environment in the country is crucial for attracting and retaining investors. The talks with the Alpha MBM hold both potential and risk for this refinery. Careful considerations for all factors and transparent negotiations will be key in securing a successful outcome for Uganda. In the event that the talks are successful, the question that is being asked is, will the new investors succeed where others have failed? Even if the talks with Alpha MBMs are successful, there is still uncertainty about whether they can avoid the pitfalls that plagued previous attempts at securing financing for the Ugandan oil. The three failed attempts at securing financing for this project, we had Russia, South Korean companies, and the recent one, the US and Italian companies. The Russian consortium, which was led by VTB Bank and RT Investment, which are Russia's state-owned investment companies, they offered 48.5 billion. They offered this project, and but negotiations fell through due to disagreement over terms and concerns about transparency. Then we had South Korea Consortium, which was comprising of SK Engineering and Construction and also Korean National Oil Corporation (NOC). They proposed to invest in this project, but talks collapsed due to disagreement over financing arrangements and Uganda's insistence on larger government stake. Then we have the Albertine Graben Consortium, which failed to make the investment decision, and PFA expiring, and the Uganda government did not want to negotiate further, and this is what has led Uganda to approach the Dubai-based company. There are some similarities with the previous project and also differences. One is that the project is large and it requires high financing, and with a price tag of 4.5 billion, getting a financier or investor willing to commit such large sums is a big challenge. There's also global economic factors, which include fluctuations in the global oil market and ongoing uncertainties. This can deter investors and make financing conditions less favorable. And then geopolitical consideration, where Uganda political landscape and its relationship with different countries can influence investor confidence and also willingness to engage. The differences that comes out that may make this time the negotiation to be successful: we have financial resource, where Alpha MBM operates in a market known for significant wealth and investment capacity. Potentially, this increases their ability to handle large deals. Then we have investment focus. Their stated interest in emerging markets and infrastructure projects suggests a potential strategic alignment with the new project. Then there is agility and speed, where compared to the government-led consortiums, private sectors like Alpha MBM might be able to navigate bureaucracy and reach decisions faster, potentially speeding up the process. However, these potential advantages are not eliminating all the risks. There is lack of experience in Uganda, where this company lacks specific knowledge about operating in Uganda oil and gas sector, and this requires careful due diligence and collaboration with the local partners. Then there is transparency and accountability concerns which have been raised, and also potential hidden cost. Deals with private investors may involve terms or arrangements that are not immediately visible, leading to unforeseen challenges in the long term. Ultimately, the success of this involvement will depend on several factors, which include negotiating a fair and transparent deal, as well as effective project management, where the company needs to build a competent and experienced team, both within the company and also in Uganda. And this will be crucial for navigating the complexity of this project. Then there's a need for adaptability to the changing circumstances, where the ability to adjust to global economic trends will help the company to address any unforeseen challenges that may come. While Alpha MBM potentially offers new possibility for the Ugandan oil refinery, past failures serve as a reminder of the complexity involved in this large-scale project. Careful considerations of risk and opportunities, alongside transparent negotiations and strong project management, will be key to determining whether or not this new venture turns out to be a success. Thank you.